Hello, I'm your host, John Cavendish, and welcome to the Amazon Strategy Show, the show that's all strategy with no hacks, no silver bullets, no magic pills, just real practical strategies to grow your Amazon business. Today, my guest is Mr. Taliesin Hollywood, who's an M&A professional with clients ranging from $2 to $200 million. He and his firm advises businesses on how to strategically maximize their asset value. He's based in London, and he's coming to us live today. So, welcome, Taliesin.
Thanks, John. It's a pleasure to be on. Thanks for having me.
Oh, thanks for being here. And I said that in the previous intro that I messed up. I was going to ask you about your name. Like, where does Taliesin come from?
Yeah, that's, to be fair,
my question I shouldn't have asked.
With a surname like Hollywood, you would have thought they would have gone for something like John, which is my dad's name and your name. Perfectly good name. But they chose the most obscure Welsh name that none of my family are even Welsh, but Taliesin's Welsh. So just to make my life a little bit difficult, I've now a very long name.
Oh, I like it. It's cool. So, I mean, it's unique.
Thanks. Yeah, it's different.
So when we were chatting about this episode, Taliesin put forward that we could really dive into the strategy that we should look into when selling a business, and that's perfect for the Amazon Strategy Show. So I thought maybe we can dive in a little bit straight into that, Taliesin, and then after that we'll go into Handbeck and what you do as a M&A brokerage.
Yeah, sure, absolutely. Just to quickly give just a bit of flavor of why I think that it might be helpful to talk about strategy. Yeah. We work with clients, as you said, 2 to 200 million in size. We only work with a small number of clients at a time, and we just provide really kind of high touch level of service, really high attention to detail. And a lot of what we do is kind of strategy. It's just helping people to not just sell their business, but to do it in a way that protects their interests and helps the deal to be more likely for the deal to actually close, for the deal to be more likely to actually close at the offer price, and get them truly the best result. So and a lot of that comes down to things that people don't often think about. So I thought for the Amazon Strategist Show, it'd be cool to talk about M&A strategy. So starting, right from preparation, things that are obvious. So everyone knows you should have your accounting in place, for example. It needs to be, accrual-based accounting. That, everyone kind of talks about that, but it's not something that everyone is actually still doing. And we can help clients. We've got chartered accountants on staff. And so we help clients to get their accounts ready if they're not ready. But it's the first thing to think about, obviously, is accounting. It's not just a matter of having your accounts ready. Obviously, we're helping them to optimize their accounts, recasting their accounts. There's a lot of detail involved in actually truly identifying the right add backs that you can add back. And if anything's duplicated, getting everything really clean so that, and we'll come back to this in a minute when we get further through the process, but having a good financial pack, very often with a forecast, that often helps as well. I'll explain why. That's really important. So people understand you need to prepare your accounts. There's a bit of detail involved, but that's just a quick point.
Accounting-wise, are businesses doing more than $2 million not using accrual accounting? Is that because they're in the US, or are there EU companies also doing that?
In the UK, you have to, but in the US, we've seen very often actually kind of like a blend. Some expenses being recognized on an accrual basis, but income being recognized on a cash basis and kind of blended. And even in the UK, businesses that are kind of approaching that level, we've seen them recognizing things on a cash basis. And it's just not the different. I kind of went too much into just the accrual versus cash, but it's not just that. It's also making sure, because a lot of the time tools are used, like Sellerboard's a really good tool. For example, if for an Amazon seller, for capturing your kind of creating a P&L of sorts. But there's some ways that any of these software tools work in the background where you have to be really sure that everything's being captured. And we've seen a lot of times things being captured twice and people not even realizing just because of the way the different columns that their software is extracting and putting in certain places. So what I'm saying is that quite often all of this only gets found out during due diligence, and that's kind of too late. You need to analyze it properly first and make sure everything's in place.
Cool. So just for the benefit of anyone who's watching or listening who's not as clued up, how would you define the difference between accrual accounting and cash accounting, and how does someone switch and make sure they're doing it right?
Sure. So accrual accounting, at the most basic level, it's recognizing an expense at the point of the sale rather than when the expense is incurred. So you're paying an invoice on a shipment of, in the e-commerce setting, have a shipment of goods coming in. and you pay that all in like a big lump sum. And on a cash accounting basis, that's when you would recognize that cost in your accounts. On an accrual basis, you actually recognize the cost of each individual unit when it's sold. So you might think it doesn't matter that much, but particularly for a growing business, if you're recognizing you're spending more and more and more on larger and larger purchases, big lump sums, and if you're recognizing each one of those on the day of purchase, what happens is you've recognized a lot of cost that shouldn't have necessarily been recognized yet, that wouldn't have been on your P&L if you're under an accrual basis, whereas the sales will be the same. So effectively, you're reducing your profit by doing that. So it's really important, particularly for growing businesses, that you kind of have it on an accruals basis. It's quite a process to retrospectively infer how that should have been calculated on an accruals basis. Historically, it's much easier. It's really the only way to do it properly is to do it from scratch, invoice by invoice, sale by sale. So to do it prospectively going forward is the best way to do it. You can retrospectively use accounting techniques to kind of make what's considered like fair assumptions about the proportion that would have been recognized based on each invoice and so on. I'm not the accountant on our team. We have a chartered accountant with a lot of experience who usually works with our clients' accountants as a team to resolve all this kind of stuff. But basically, that's how it works.
Awesome. Yeah. So just from my understanding, just so I can try and explain it to anyone who's watching or listening, if I understand it right, is that you have cash, you get inventory, that inventory turns into the cash, then turns into inventory, but it's still sitting there basically as cash. It's just you've got cash money, cash inventory. Then you make a sale. During the sale process, at the point of sale, that inventory thing now becomes an inventory thing that's been sold. So you've turned it from cash inventory into a sale.
That's right.
So on your P&L, you see cash in cash, cash in inventory, cash sitting in the bank account. It's all the same thing on the P&L.
Yeah, exactly. And so on an accruals basis, it stays on the balance sheet for longer, and doesn't move to an expense on your P&L as early as it would under a cash basis. Then you're kind of moving that whole purchase onto your P&L as an expense. Yeah.
So then these guys, once they do that, it's great because it shows you the real profitability of the business, but it doesn't show you the cash position of the business anymore. So you need to make sure you're looking at your statement of cash, your P&L, and your balance sheet. Otherwise, you might go, I've got so much money, but it's all inventory and debt.
Absolutely. Yeah, that's actually a really important point.
Awesome. So you've do the preparation. What else should we be doing to prepare the business for sale?
So things relating to IP all need to be in place. Compliance issues all need to be in place. Legal, there's some issues regarding IP or legal issues that not everything can be perfect, but you need to preempt how the buyer will see each one of these issues and have good answers in place to the expected questions. If you have some kind of IP infringement issue, or if there is a compliance issue, which from all of the context that you have around this niche market is relatively small, it's important to be able to show that, not for them to just have to take your word for it. So you have to have everything in place that you think, if you were a reasonable buyer, and that's how we can often help by explaining how the buyer will see this. Preparing all of that so that's ready when they need to look at it. Thinking about who to sell to as well is important. So taking a proactive approach rather than just being completely passive. Not to say there's necessarily anything wrong with being passive and just kind of advertising a business for sale. You can find buyers that way. Being proactive means identifying the buyers for whom your business would be a really good fit. Ideally where they can make more money from it than you can, and going and approaching them proactively. The timing of how to do that with each buyer type. The aggregators and very active PE firms for whom acquisition is like their raison d'etre, they're ready to acquire. They usually respond more quickly than say a strategic who might be in your industry or a related industry, who their raison d'etre is just to continue running their business. They may or may not have a corporate development department, but even if they do, it's not core to their operation. So all of those guys take longer. So you have to think about maybe approaching those guys first if you want them to be in the process at the same time as the ones who are going to move more quickly. Broader timing issues regarding even just when to when to go to market regarding everything else around your business. That no one has a crystal ball. You can't exactly tell the future, but business owners usually have a good sense of what the next 6 months, at least 6 to 12 months, is going to look like, and how the trends are going. And they've been growing and growing and growing like crazy, but they feel that the drivers of that growth are starting to kind of burn out, or that there's a bit of a fear that they might run out and they don't know what's around the corner. That's often a bit too late to go to market, because during a sale process, if it does turn a corner and start to go downwards, you become at a real disadvantage compared to the buyers, who they can use that to their advantage, and it changes the whole kind of power balance in the deal. So trying to time things before that happens is also important. I think something that's not considered enough at the early stage is risk, because this comes up very late in the process. So M&A advisors like us help our clients to think about everything that we can, but we're typically associated with the commercial terms, like the price of the deal, the earn-out timings and so on, the structures, deal structures, marketing, how to present the business in the best light, all that kind of stuff. And then their M&A lawyer, if they have a good M&A lawyer, they're talking about largely risk allocation, which is a bit different to the whole area of the commercial terms. And it's the very end of the process, towards the late stages of due diligence, where these documents start getting drafted up, and both sides are trying to allocate risk and reduce the amount of risk that they're taking in the deal. And that is often the first time that the seller really starts to think about risk. In our experience with our clients, that they really very often haven't thought about that until then. So we like to help our clients to start thinking about that early. We're not lawyers, but we introduce them to lawyers if they don't have a good M&A lawyer, and just think about how much risk the buyer will want to take on, and how the process is going to play out, how it works with drafting these documents, just at a very high level, so that they can understand the types of risks where the buyer won't want to take much risk, and what the buyer will do about that. So what that actually means in terms of having to indemnify the buyer for something that might go wrong in future, and the types of things that we would want to disclose to therefore put some of that risk onto the buyer, and how much risk the seller is comfortable with, because it's a huge area. It's a really important kind of consideration. Ultimately, if you continue owning the business, you continue having all the existing risk that you currently have. But it's something that, business people are optimists, and we're aware of risk and we try to minimize risk, but without really focusing on all of the different things that could go wrong, we're just innately not aware of all of the different risks that we're currently taking. And through this process, it helps to be aware of all of that and come to a bit of a balance as to like how much risk you're happy with and how much risk you're happy taking and passing on to the buyer.
So when you talk about risk, do you mean risk of something like a product, like product liability type risks that were happened while the seller owned the business, or do you mean other types of risks as well?
Yeah, well, it could be anything. So yeah, product liability is one example. Very few people have a perfectly clean record of marketing that's absolutely in compliant with Amazon's terms of service as they stand today. Amazon's terms of service is a movable feast. They're always changing it.
Yeah.
And there's always some things that you're not 100% certain that the buyer will be comfortable with. So obviously you want to disclose all of that, but disclosing all of that puts the risk onto the buyer. Sometimes they're not happy with that. That's one area. If you've been engaging in full-on black hat tactics, obviously most buyers are not going to be happy with that, and you probably will kill the deal. I'm talking about more grey hat things, product insert.
Like old businesses that have done review incentivized stuff that wasn't again terms of service 5-6 years ago, but now would be frowned upon.
Yeah, exactly. Yeah, that's one classic area. The compliance or IP types of issues that we kind of briefly glossed over, they're very common. And businesses manage these just by, obviously each case is unique, but very often minor IP infringement. There's often very false IP infringement claims and things. And so viewing each one of those through the lens that the buyer views it through, you have to understand how they'll see it, how much risk they're going to see it as. Part of the job is actually clarifying everything and reframing it so that they understand, so they can see how small of a risk it is. But once you get to that point, you have to accept that there is still some risk and weigh up who's going to take it, how much of it, in what way.
So yeah, and that's all stuff that you don't really get into until you get into proper deal negotiation with lawyers, M&A
Yeah.
lawyers.
And because of timing issues late in the process, we'll get on timing in a sec. Quite often, and deal fatigue, like sometimes these deals go for a long time. Having an existential issue like how much risk am I going to take? Right at the point where you have deal fatigue, you're exhausted from this whole thing. You're trying to close it as quickly as possible for reasons I'll say in a minute. It's not the ideal time to be dealing with big questions around risk. So at least being a bit prepared for that in advance helps.
Yeah. So you've done your preparation, you've got your accounting, your IP stuff's in line as much as possible. You want to know who you're going to sell to. You know your timings, so whether you're approaching your strategic buyers early on or your aggregators, once they've got their checkbook out. You know when to go to market, and you've kind of talked to yourself about risk. Then you start talking to people. What's next?
Yeah, absolutely. The marketing process itself is important. How you present the business is important. That's something that M&A advisors like us are known for, being able to identify sometimes things that even the owner of the business themselves doesn't really kind of think about that much as to what is an opportunity in the business, and really teasing everything out, identifying where the real growth opportunities are, identifying risks, speaking of risk, identifying problems in the business and reframing them, having the opportunity to reframe them in the light that presents them as something small rather than some big problem. So how you present all that is important, getting all that right. Then going to the right people at the right firms, getting them all in the process at the right time, having the conversations. That'll put you in that's the start. That gets you in the position where you're in a good position to potentially get a good deal. Then it's negotiation, and negotiation is more than just like the question of ultimately how much are these person going to pay. Negotiation involves a fair bit of preparation as well. Obviously, something that can help with strengthening your negotiation position from the very start is knowing that your best alternative to taking any particular option. So sometimes people call it BATNA, best alternative to a negotiated agreement. So that's if you only have one buyer, your best alternative is walking away from the deal. You can bluff or, just simply not tell. Obviously, you wouldn't tell the other party that you're only dealing with one buyer. Unless they ask directly, then you probably would still refuse to kind of reveal that information. But that's an awkward position to be in. And so either they find out or they don't find out. The fact is, if you don't accept their deal, then your best alternative is walking away. However, if you become comfortable with that and you realize at what level this deal is good enough for me to accept it and what it isn't, and what terms and what level of risk, your negotiating position, even with one buyer, is actually quite a lot stronger. It's a lot less stressful because you can just confidently say yes and no, and you know what you can push on and how far you can push, and you know where you're going to walk away. So that's the next thing. But that's not the ideal. Obviously, the ideal is to have as many buyers, as many good, serious buyers as you can, so that you have an alternative. And that helps you not only from your own psychological point of view, and in this case, you do let the other buyer know, obviously not who the other buyers are, but that there are other parties. It puts them under pressure. So having as many legitimate buyers as you can in the process is important. So I say legitimate, not because people are, legitimate or illegitimate. What I mean is, it's important to weigh up, and this is where the preparation and negotiation also is part of it. It's important to weigh up with each buyer their likelihood of closing the deal before you consider going into exclusivity with them. And it's important to weigh that up for all of your alternative options as well. So not only who they are and what the cash offer is, but how likely they are to retrade on that deal, how serious they are. Some buyers will send out a lot of LOIs and try and get people under LOI as soon as possible, and then just pick and choose the few that they want to actually close. Others have a completely different strategy where they only will send out LOIs where they're almost certain they want to close the business and close the deal. And it's only if something really unexpected comes up in due diligence that they'll pull out. So understanding as much as you can about each buyer and their seriousness is very helpful when you're kind of going through this process in terms of choosing which buyer you want to go with, and in terms of really understanding to as much a degree as you can what your alternative options are.
So with that, how do you judge your buyers, or how do you decide, how do you know who you should trust, who you think is going to close and choose one?
Yeah, part of it comes from reputation, and working with experienced advisors helps. Although we know all of the aggregators, for example, almost all of the aggregators we know fairly well. But even we can't know every detail of their strategy, but we can give you an idea. Reputation in the market is important, and you can find out from other people as well. But most importantly, simply asking them. Like, you can ask on the LOI question, you can ask about their LOI to close rate, and that can give you an indication as to, like, just broadly speaking, if they're closing most of the deals that they sign or not. You have to bear market conditions in mind as well. A company that you see, a buyer that, say it's an aggregator and it was in the second quarter of 2022, a lot of deals fell over simply because driven by their investors.
Yeah,
you'd have to bear that into mind, but maybe you'd ask them over the previous 12 months what their LOI to close rate, or now that we're in 2023, this is January 23, you could ask them over the whole of 2022 what was their LOI to close rate, and they should know. They should be able to tell you. If there's any reluctance, that's a sign in itself. This is important, actually. Trying to predict what the buyer is going to do in due diligence is important. So on your accounts, the more clarity they can have and the more confidence that you have that they are really clear about everything in your accounts before going into exclusivity with them, the better. So if possible, we try to get written assurances from them that they've analyzed the accounts, they understand our calculation of the SDE or the EBITDA, and they accept it, and they accept everything. We'll give them backup data or the original source data, and we'll actually ask them to go through it and confirm that they're happy with it and that they're not going to look at this for the first time during due diligence and then, surprise, surprise, find something that they're not happy with and think that this should not be an add back or whatever.
Nice. Just like an upfront agreement.
Yeah. Nothing in the LOI stage is actually binding, except for the exclusivity of the agreement and the jurisdiction. But at least if you have something you can refer back to where they said, no, we saw this before, we can say, no, you saw this beforehand, you agreed to this. Then if they push on it, then they're retrading, they're doing something that's kind of not in line with the spirit of the deal. And both sides know that that's basically not fair. And it gives us much more ammunition as to say, well, we're going to go with a different buyer, you're messing us around here, and so on. Mm-hmm. And we've used that several times actually to get them to drop buyers to drop claims about add backs that they were really pushing on, that their due diligence providers said, no, this should not be an add back, but they'd agreed to it beforehand and we got them to drop it. It's just important.
I love it. So yeah, as you said, we're in January 2023 now. So the multi-million-dollar question that everyone would like to, I guess, who listens to this anytime soon would be, what do you see happening now in the markets after what was happening last year?
It's not great, to be honest. There's still a market for great businesses, absolutely. But compared to 2021, certainly in the first half of 2022, the buyers have slowed down significantly. Some of them are still on pause. Thrasio is back buying businesses again, but they've completely kind of changed their strategy. They're looking for larger businesses, by and large. The fact that they've kind of removed what was their growth team, M&A team, and not aggressively trying to acquire businesses as fast as possible anymore. And that's the story for most of them. They're cautiously acquiring. So acquisitions is still a key part of their strategy, but they're just much more cautious than they were. So for sellers, that means if you've got a really attractive business, you'll still get a good multiple. There'll be multiple buyers. We'll be able to get a situation where we have good, very good offers and good backup options for you. If your business is on the smaller side, or if your margins are being compressed, then it usually, for most sellers, it means waiting a bit longer, growing it a bit more, strengthening your margins again. Thank goodness shipping costs have come down, but Amazon continues to increase their fees. So it means potentially waiting to go to market when you have a larger and more profitable business, because more buyers are going to be interested then.
Yeah. So when you say good multiple, like what multiples are you seeing at the moment as a range in the marketplace? So
yeah, we normally talk about upfront multiples rather than kind of trying to estimate an earnout.
Yeah, that makes sense.
Like I said, we only work with a small number of clients at a time, so our own data points for our own deals is relatively small. But the buyers tell us, and other sellers tell us, and just M&A lawyers tell us about the market and what's happening. And so, we're seeing at the moment kind of between 2.5 and 4.5 times upfront for deals that are led by M&A firms. Sometimes we have heard of M&A firms marketing deals at only 2.5 times, and then those deals selling for less than 2.5. We haven't sold anything for. I'm cautious about revealing exact numbers because some people know some of the buyers that we've worked with and they would expose. But we're at the very top of that range. All of the deals we've closed have been towards the top of that range in the last 12 months. Now, we have heard of a lot of sellers that are selling without M&A representation, even below 2, some deals closing at 1.75 times STE at close.
And that's upfront. So what kind of back-end earnout? So upfront means cash, or is that can still be cash plus equity cash over time? Could it still be, or how does that work?
Actually, yeah. Still, most of the deals are predominantly cash or cash with a bit of equity, like equity in the parent. The buyers are getting more, we're finding buyers are getting more imaginative and creative with deal structures. So we've seen not just the standard earnouts, but we've seen accelerated earnouts to kind of sweeten the deal, where the upfront amount can be palatable for the buyer's investors, that they're not overpaying for the deal. And they have an earnout, but they'll sweeten the deal with an accelerated earnout. For example, that it might be a multiple of profits instead of a percentage of the profits. It might be a multiple of the profits over a short period. And it's usually more achievable to hit. It might be in the next 6 or 12 months rather than further down the track. Yeah, we've seen shadow equity deals being structured where the idea is none of our clients have accepted one of these offers, so we haven't been through right to the end with it. But we've seen several of them where they're suggesting that the owner of the business would retain some equity in their own business in the form of what's called shadow equity. And the buyer would pay for, say, 70 or 80% of it up front, and then the remaining 20 or 30% at some future date. With the idea is that they're going to grow this business, and that 20 or 30% is going to be worth even more later. That's the idea. I think both sides have a little bit more skepticism around, just compared to, say, 2020 and 2021, when there was a lot of tailwinds behind e-commerce, and running out of stock was a major problem for most people rather than getting enough sales. Then post-COVID, there's been some headwinds, and I think everyone has a more realistic understanding now of the difficulties and the nuances involved in running these small businesses. So I think both sides are less bullish on the future on the short-term future for their businesses. That doesn't mean that they're bad businesses. They're still, they're great. It's particularly the ones that find their way to us are usually exceptionally good businesses, and with long-term growth potential. It's just that not everyone is bullish on growing 100% in the coming year, like they were in 2020. So it changes your expectation.
Yeah, I get that, and I find it interesting the way that valuations change over time, because I've been around the Amazon industry for the last 8 years or so, and they've they peaked, they've gone up, they've gone down, and if there's long-term future in the business, 2x just seems so cheap to get hold of any kind of asset that if it can pay you back in 2 years.
It does, doesn't it?
It's amazing, isn't it? It's like free money if you can keep running this thing in the way that it's supposed to be run.
I agree, yeah. We do have to factor in inventory as well. That's an additional kind of cost that the buyer has to come up with. They don't get a return on that. But even with that aside, buying a good business that has long-term growth potential at 2 times, that's why I still have a lot of confidence in the kind of aggregated model, that ultimately, these assets will be worth more in future. That they're diversified holding companies with assets that are, although not every asset is going to become the next Tide washing powder. Not everything is going to be a multi-billion-dollar brand, and some of them won't last more than a couple of years. But most of them will continue to grow into the future, 5, 10, 15, 20 years, and will provide a good return. Yeah,
I mean, I hope so. Otherwise, there's going to be a lot of aggregators going out of business very soon. Yeah.
In Q1, it's going to be an interesting Q1, actually. We speak to sometimes speak to the investors in this space as well. Sometimes they ask us for insight and stuff. And I think Q1 is going to be interesting with probably more reports of consolidation. Yeah, I don't have any specific, inside info, but definitely what.
Well, I'll get you back on once it's been announced, and you can offer your input.
Sure. No, it's just definitely the very clear vibe that we're getting from them is that I think in Q1 we're going to see a little bit more of that. But that was in a fragmented market. That's always the case. Not everyone survives. It's just the nature of it. Some people, some companies do better than others, but on the whole, I think later in 2023 we're going to have a lot more stability in the market, and things will be able to grow from there. Yeah,
I like that, and I mean, I think too many businesses in every sector have lasted way too long over the last few years, haven't they? We've all got, all businesses have got fat and overspent on staff, overspent on everything when times were good. So now the ones that need to fail will get consolidated or fail, while the strong ones get stronger. So I think it's good. Otherwise, you're going to have too much money everywhere.
Yeah, absolutely. It is natural.
Nice. I mean, I love that. So we've been through basically everything that you need to take into account strategically to when selling your business. Almost. What's left?
A few more points. Just we're almost. The process is quite can be quite long. So there is a fair bit to it. But just the last kind of few little points I wanted to add were related to the later stages of the deal. We're actually drafting the commercial agreements, and I think it is important, even though it sounds obvious, it's important to closely watch what happens during this process and make sure the commercial terms reflect what was agreed at the LOI stage. Lawyers are usually M&A, even we work with really good M&A lawyers, and they're very concerned about risk and making sure the client doesn't take too much risk, which is super important. They're often tied up on compliance things and IP things, a lot of moving parts in these APAs or SPAs. And sometimes actually very often the commercial terms can shift a little bit from what was agreed, even if it's a subtle thing of moving some of the consideration, some of the purchase price might be moved into what's called the contingent consideration. It might be subject to something, to some other requirements of the buyer, whereas it should have been completely guaranteed and therefore not contingent on anything. Some of it will be moved in contingent consideration. If no one's there to watch that, you end up with a deal that kind of looks similar to it, but it's not the same deal that was agreed at LOI. So it's important to kind of watch the details of what happens and to negotiate all the commercial terms in conjunction with good M&A lawyers. There's a couple of other, I guess the most important other term to kind of consider, and again, this is all a negotiation, but particularly in a sector where there's a lot of consolidation, it's useful to kind of think about what will happen to the deferred consideration in the event that the buyer, that the buyer becomes acquired, or the buyer merges, or the buyer actually sells that brand. So without anything in the terms in the contract to specifically define that, sometimes the seller is at risk. So it's worthwhile, in the absolute best scenario from the seller, you can get the buyer to agree to put terms in that they'll pay out the full amount or an estimated amount, which you put in literally in a dollar figure or a pound euro figure in the SPA. We've done that before. This is the amount that the earnout is worth if this asset gets sold, or if the buyer gets acquired or merges with another entity. This is what the seller will receive. They don't always agree to that, but there's middle ground that you can get that will protect the seller.
I love that. That's great. Yeah, having someone on your side who thinks about all this stuff, because otherwise you could be 6-7 figures or 7 figures worse off should something happen, or 8 if it's a huge deal.
Yeah, absolutely. And the reason that the M&A lawyers are rightly concerned about risk is that even if you close an 8-figure deal, if you're not looking at the terms, there was someone who was asking us for advice early in the process, and then kind of just decided to run the deal on their own. But amazingly, I found out afterwards they chose to actually fire their lawyer as well. And so they signed this deal that looked good on commercial terms, but they were on the legal terms. They and even some of the commercials, they signed a terrible deal, very good for the buyer, because this is what the lawyers are actually worried about: signing an 8-figure deal and then basically owing the buyer 8 figures in compensation afterwards for something that's relatively likely and not that big of a risk, And so the middle ground more often might be that you've taken a fairly minor risk, you've allocated some minor risk to the buyer. If something really unusual happens that that's fair that you should take some of that risk. Maybe, a portion of the consideration that you've been paid might be owed back to the buyer or something. But if the lawyers are not watching that, then you could end up owing the buyer quite a lot of money.
I mean, I've seen that as well. Like one of my best friends exited to one of the aggregators, and he got great multiple just before multiples peaked up, but much better than they are now. So he did all right out of it. But his earnout was significant and based on, I think, ridiculous growth targets for the business, and hit during COVID, but post-COVID not hit, and also and there was no stipulation there for the buyer to do anything. So they had to hit these growth numbers, but there was nothing in the contract that they had to do anything to hit those numbers. So my thoughts would be that there should be something in there. Otherwise, how are you going to hit 30% growth without doing something? I mean, it's crazy.
Yeah, good point. We saw we have a client who sold a business to an aggregator, and he's selling his second business now. And they just let all the, they were one of the larger aggregators, and they were buying lots and lots and lots of businesses. But they just didn't pay any attention to it at all. When you say did nothing, they let it run out of stock. And the stock that they did have in the US, they shipped that was heading to the US. They diverted it to Australia for the massive Australian Amazon marketplace, and his US marketplace ran out of stock. Things like that are, preventable.
Yeah. It's good. Talk to a real expert. Okay, so Taliesin, can you tell us a little bit about Hanbeck and what you guys do?
Sure, absolutely. So Hanbeck is an M&A advisory firm for consumer brands. So we're a little bit different to a broker in that our processes are quite a bit more intensive. We're not our main objective isn't merely to find buyers for you. That's part of it, but we just provide a lot more support right from the very start in terms of preparation, right through due diligence. All of our team, we only have a small team, but they're all pretty senior. So, chartered accountants, people with 15 years M&A experience from, global investment banks, that kind of thing. So good people. We've got our head office is here in London, and we have an office in North America in Vancouver, just so that we can cover buyers on both sides of the Atlantic. And that's who we do. I guess we're known for working with really large Amazon sellers, some above 100 million, but we also work with clients right down to 2 million. That's completely fine for us, that whole spectrum. I think we're known for just getting really good results. We publish some of our results on our website and known for getting good results for our clients.
Awesome. Cool. So, listeners probably have heard of, Empire Flippers or Quiet Light or FE, and they're kind of brokers. So what's the difference? What's the main difference when somebody should think about going to a broker or coming to talk to yourselves? And what kind of position in their journey should they do that?
Sure. Yeah. And all three of those firms have really good reputations. And they've all been in this space for a very long time. An M&A advisory service is quite a different approach. So if you want to work with someone who only is taking on a few clients rather than taking on lots of clients at the same time, then you'd probably be more inclined to work with an advisor. If you're happy for the process to be relatively what I would call passive, so for it to be advertised on a marketplace and for thousands or tens of thousands of buyers, eyeballs to see it, that can be a really good thing. And for it to go out to a really big email list, that can be a really good thing as well. So brokers will do that. We don't do that. Our approach is entirely confidential. We don't work really with individuals, so we don't need tens of thousands of individuals on our list. We are really proactive. So we spend most of our time actually working with strategic buyers, so identifying people in, companies basically in your industry or in related industries who would make more money from the acquisition than anyone else would. So we spend a lot of time identifying them and reaching out to them and bringing them into the process, as well as obviously all the Amazon aggregators who we know really well. We know many of their investors and so on.
Cool. And what's the fee model that you guys work on? At least, maybe not a specific fee, but what's the model? Sure.
Yeah. No. We've got a transparent fee model. It's just 5% on success fee. So we have a small upfront, like a very small fee, which is deducted from the commission at the end. So basically, that makes us aligned to our clients, so that if the deal doesn't close, then it's disappointing for everyone, basically, and they haven't invested an enormous amount in the advisory service. and everyone's aligned that way.
Oh, that makes sense. Is there anything else you think people should know about using an M&A firm over a broker or anything like that?
Ultimately, you should probably speak to both, and you can make your own decisions. The differences are in the way we work. I think that comes out in the details of what we're doing during due diligence and the support that we're providing, our approach in terms of the preparation that we're doing and most of all the strategy. Since we're on the Amazon Strategist show and we're talking about strategy in this call, I think it'll come through that the approach that we take is much more strategic, and we think that ends up in a better result.
Very cool. Thank you for sharing. Just out of my interest then, I know it's a random piece of string, but what's the kind of time usually between somebody coming to talk to you, having the business ready to shop around, to show to prospective buyers, and closing?
Sure, yeah. The last part, the closing, has actually lengthened a little bit over the last 6 to 12 months. As buyers have become a little bit more cautious, actually quite a lot more cautious, they're taking due diligence more seriously, and they're taking longer. So frustratingly for everyone, that has gone from where it used to be, they would say 30 days, and we actually did a couple in less than 30 days, which was just incredible in the M&A space. It's really unusual. But typically they were around 60 days to close. Now it's not uncommon for it to be 90 days from the signing of the LOI until close. Obviously, we try and get this. We don't offer a 90-day exclusivity straight up. We usually sign a shorter exclusivity period, and all sides work towards getting that closed as soon as possible. But the nature of the beast at the moment is that sometimes it takes longer. So your question was about the whole process. So we have clients coming to us quite often up to a year in advance before they're ready to sell. And so we're advising them on getting prepared for everything before that, which it just makes sense, thinking about things in advance. And then it also positions you in a good way to find the right time to go to market, which is quite helpful as well. When clients come to us when they're kind of ready, or they're kind of almost ready to go to market, the fastest that we've been able to bring a client to market in that situation is a week, but that's really, really unusual. Usually the type of preparation that we're doing usually takes about a month to get everything ready. So typically it's about when they come to us, if everything's ready from their side, or almost ready, like it's the right time to go to market, then usually it's about a month for us to get everything ready, work with them, optimize everything so that they'll get the best results. Then it's a month to go to market. The process itself, running the process, takes around 3 to 4 weeks to get everyone involved, strategic buyers and aggregators. Part of that month preparation beforehand was also spent identifying strategics and getting them into the process so that they can be in the process at the same time as the aggregators. Because the aggregators and anyone, even some PE firms whose kind of raison d'etre is to make acquisitions, they respond quite quickly. So that process takes about a month to get to the offer stage. There's negotiation of offers, which is a few days to a week, and then you go into due diligence after that.
All right, cool. So actually, it's not a particularly lengthy process overall. It might be, a month's preparation, month with talking to buyers. Then, if the first deal goes through, 2 to 3 months more on the back end.
Yeah, that's right. 5 months, 5 to 6 months from getting started to completion is pretty standard. Yeah. We have situations, just things happen, and we've had, a number of situations where during the preparation process, something's come up, maybe an IP issue or a compliance issue or something that needs to be resolved. So then you would pause and resolve that first for maybe another 6 months. And so that's not uncommon either. But if nothing like that happens, then 5, 6 months.
Great, cool. Thanks for indulging my curiosity.
Sure, yeah, and of course.
So if somebody would want to work with you, what would they do? What's their first step?
I guess our website makes sense as the first step, just hahnbeck.com, www.hahnbeck.com, and reach out to us. My email is th@hahnbeck.com. And yeah, we've got there's a valuation calculator on there that's kind of cool. It's unusual because it's not just like a lead generator for us. It actually gives you an instant valuation. It's only a guide, but that's quite helpful. And we're building more software all the time. We've got another cool tool coming out in a couple of months that's we think is going to add a lot of value for sellers. So yeah, come to our website and and it's probably the best place.
Yeah. So yeah, thank you so much for sharing. That's really, really cool. And yeah, I think this is going to be a great bit we can extract as well to share just as a value add of what people can do to prepare their business strategically for sale. So yeah, thank you.
Great. Awesome. Thanks, John. Pleasure.
So next bit, we're going to go into our game section of the show.
Oh yeah. Cool.
Where we like to give back to our audience. So we do have a way to register. So if you're watching the recording of this, because you must be, because no one's watching live, there should be a link where you can register for this, and then you'll be entered every week for the giveaway. We have some amazing prizes from Taliesin and also from many other previous guests. Taliesin has very kindly put forward a free detailed consultation. Is that with you?
Myself, or to be honest, we've hired some of the best people in the industry, so they can happy to have it with myself, or my colleague Maylin has more than $2 billion in transaction experience. Dell has 15 years experience in this industry. So Ashley is a chartered accountant, sold a business was involved as a part of a deal of selling a business to Amazon once, which is really unusual. But yeah, any of us.
Cool. Well, I think you should talk to Taliesin. He's an awesome dude. And yeah, and we have many other things. We still have consultation with Amazing at Home with Amy, Brian Johnson of Canopy Management, Don from AccrueMe. We've got a lot of different prizes on the wheel. So if Amazing Assistant would bring up the wheel, that would be amazing. So now, Taliesin, you have control, verbal control. If you just say spin that wheel, we will spin the wheel.
Spin the wheel.
Sound that in the post.
Yeah, I love it. It's like a game show from the 80s.
So, amazing marketing free listing audit consultation. That's awesome. So, Amy from Amazing at Home. We'll be introducing you, whoever win this, to Amy after the next episode. So we'll be announcing the winner on the next episode. So thank you for putting that in. Now, one more time.
Spin the wheel. Is it working?
Yeah, working. Thought I'd lost sound. And AccrueMe. So we have a 30-minute consultation on any topic with Don from AccrueMe. Don is an amazing entrepreneur and a really, really cool guy. You're going to love a conversation with him. And should we do it one more time?
Sure. Spin the wheel.
Countdown music. And Canopy Management. So an audit call, not an audit even, with Brian Johnson directly of Canopy. So you're going to get to meet Brian. So congratulations, and please enter the competition below so that you can win that.
Amazing.
Awesome. All right. So one question that we ask to every single person that comes on the Amazon Strategist Show, which is, what is one strategic element that you think most people are missing while selling on Amazon?
It's a tricky one, because I think brand, I was going to say brand, because it's, I wouldn't say most people are missing it. There are some really great brands, but it's something that we see quite often is just not enough attention to building a unique brand or having products that are really differentiated from competitors. Yeah, it's something that's important, both in terms of, doing well on Amazon and in terms of selling the business when it comes to talking to us.
Nice. Thank you. That's a good answer. So now we have our rapid fire questions. So we have 7 today. The number seems to change every time I do this. I don't know what they're adding and removing. All right, ready? You ready to start?
Yep, ready. Let's go. Okay.
This is your life. And question number 1, what's your favorite Amazon niche?
Baby.
Is that me or the niche? If you could choose one with either no pictures or no reviews, which would you pick?
Oh, no pictures. Yeah, I think reviews are really critical. Pictures are too, but reviews are even more.
Name a country that starts with the letter T.
Tanzania.
Which Amazon marketplace is the next big opportunity?
I was going to say India. India is the fastest growing, but Japan's a huge, just a massive economy. Obviously, there's a lot of competitors to Amazon in that marketplace, but I think Amazon has a lot of space to grow in Japan.
I agree. Pineapple on pizza, yes or no?
Yes, like Hawaiians.
Name something appealing about working from home, if you do.
Flexibility. We've got children. I'm not sure if you guys have children yet, but it's just the flexibility of working from home is really helpful. We're in the office today, but all our team is all, part in the office, part from home. Yeah.
And name something you'd hate to find swimming around in your bathtub.
Cryptosporidium parasite, which was in the Sydney water supply once about 20 years ago.
Yeah, that's the most unique answer we've had. So thank you so much. That's cool. All right. Well, that's all the questions for the show. So if people do want to reach out to you, get in touch with you, how can they do it?
Just through our website, hanbeck.com, or email me at th@hanbeck.com. Sorry, yeah, th@hanbeck.com.
Awesome. So yeah, thank you so much for being on the show.
Pleasure, John.
So if you've enjoyed the show, please do subscribe, comment below wherever you're watching this, whether it's on YouTube, Facebook, LinkedIn, Twitter. Until next time, I'm your host, John Cavendish, and thank you for being on the Amazon Strategist Show.
Thanks, John.